All right, so we continue with financial management, lecture number 3. We continue with assets and liabilities. Let's see what we have. Residual claim. Stockholder equity represents a residual claim. So let's explain the residual claim. All liabilities, the right-hand side, represents a claim on assets. Some have higher claims, some have lower claims. Higher claim will have employees, utilities, bills, things that you gotta pay urgently. Probably one of the highest claims will be the government. Government taxes will probably have the highest claim. So you can order different claims by priority. In other words, if you're running short on cash and you can't pay everybody, in other words, in the process of bankruptcy, who has the highest priority, the second highest priority, the third highest priority? And the question is, who has the lowest priority? The lowest priority always have common stockholders. And that lowest priority represents a residual claim. Residual means you have a claim after everybody else has been completely claimed, has been completely satisfied, whatever is the residual you're claiming. So you get whatever is left as a stockholder. So common stockholders have a residual claim. That's the meaning of equity. That's the meaning of being owner. Being owner means you take all the risks. Everybody else gets paid. You might get paid, you might not get paid. But you also get all the profits. You pay everybody what you owe, and you keep all the profit for yourself. Well, that's the meaning of profit. The meaning of profit is whatever you get after you pay everybody else whatever you pay. And whatever you don't pay, you keep for yourself as profit. That's the meaning of profit. All right. And from residual claim comes what we have in accounting and finance called the balance sheet equation. Balance sheet, sometimes they call it fundamental equation or accounting equation. So, balance sheet equation, this is equal sign, is the same as the accounting equation. And the accounting equation is very simple. It is assets equal liabilities plus equity, which is simply saying, or mathematically equivalent to saying, that equity is simply assets minus liability. Well, all it's saying is that equity is simply a residual claim. It is a claim on all assets after you have satisfied all liabilities. And whatever is left, we call equity. So equity, and I'll circle it here, and put the arrow, is simply a residual claim. Well, it is the residual claim on assets. That's the meaning. That's the definition. That's what it calls equity. All right, we move on to, again, page 31. I already did current assets. I already did fixed assets. I already did liquidity. Property, plant, equipment, and everything else. I think I did last time dividend. And dividend is simply a payment by the corporation to the investor. And it is a partial return of profits by the corporation to the investor, usually in the form of cash. But sometimes it could be in the form of stock. The corporation can pay a dividend in the form of stock. For every 10 stocks, they give you one more stock. This kind of dividend is called a stock dividend. If it's cash, it's called cash dividend, okay? Dividend may be in kind. They can give you a hamburger, like a Big Mac cheeseburger, okay? They can give you something else. They can give you pens or pencils or laptops, again. But all these in-kind dividends, investors don't like them. They probably might not need them. Not everybody needs a watch. They may already have a good watch. Right? Many don't need a laptop, right? Many don't need pens. So, the preferred dividend is typically a cash dividend. And that's the most common dividend. Of course, what corporations do is try to fool investors into believing they're giving them dividend when they say, okay, we're going to give you a stock dividend. Corporations usually give stock dividend for one reason. They don't have cash to give. They didn't generate enough cash to give. So they give stock, and that keeps a lot of investors happy. Why the investors are happy? Because they're getting something, which is just a piece of paper, just another claim. And most investors, they're not taking investment courses like you. They're not taking finance courses like you. Most investors don't understand that the new share that they're getting is not worth anything. Okay? It's not worth anything because it dilutes the value of all other existing shares. So when a corporation pays you a share dividend, they paid you nothing. Okay? It's not a big deal. That's a very common way to mislead and fool investors, and probably 90% of investors are unsophisticated. They don't know, they don't understand, they think they're getting something when in reality they're not getting something. Actually, stock dividend is, for good investors, a really negative signal. Well, why are they giving stock dividends? It's most likely they didn't generate enough profit in cash, okay? All right, moving on. Current assets. And we go on page 31 through the different current assets. They give you the 4 or 5 key ones. First one is just cash. Now, cash will include two things. Number one will include what's called petty cash or vault cash. This is cash which the corporation keeps in cash, in banknotes, okay? And they just have, and they can actually take it in from the vault or from the safe, and they just take it and give you money, okay? So, what's called petty cash or small or vault cash. Of course, keeping cash in hand is risky. If people know you're keeping a lot of cash, they're going to come to try and steal it. So most corporations keep their money in the bank, okay? And we call this demand deposit. That's just a deposit at the bank that you can demand, meaning you can take in cash or use for immediate payment at any time. Okay? Question? Demand. Yes, thank you. Demand has a letter D. Demand deposit. Yes. The other is called, another type is called cash equivalents. and cash equivalents are highly liquid, meaning very easy to sell, very secure, very safe, very low risk securities that you can sell at any point in time practically at no loss. So they're safe, they're secure. One example will be T-bills, treasury bill. There's a big market for them. You can sell them anytime. Almost any bank will buy it from you. Almost any securities dealer or broker will buy it from you. Easy to sell. It's in a matter of minutes, maybe even seconds if you already have the relationship. No big deal. Sometimes bank CDs. Many bank CDs, we call these, they have to be negotiable. Negotiable CD is a certificate of deposit issued by a bank, and if it's negotiable, means it can be sold, it can be transferred. Negotiable in law and finance has a different meaning. Negotiable in law and finance means the title can be legally transferred to somebody else. That's the meaning. It can be legally transferred to somebody else. That means negotiable. From this, it follows that if it's negotiable, if you can transfer the title, it means that you can actually sell it. So, you can actually sell the instrument. And if you can sell the instrument, it means you can negotiate the price for it. Okay? That's why it's called negotiable. Not because you can negotiate it, because you can actually sell it, and because you have the legal right to sell it. And in the process of selling, getting a price. Alright, so negotiable CD will be another type of cash equivalent. Alright? And there may be more, as long as they're safe and liquid. Okay? Low risk and liquid. And another component which the textbook conveniently omits is not just in there, but of course, immediately as I ask some of my other foreign students, of course they say, yeah, foreign currency. Of course, foreign currency, if it is liquid and easily marketable, is cash, okay? For you here in Taiwan, US dollars are highly liquid, safe foreign currency. It sure counts as cash, there's no question about it, okay? Well, what else? In Europe, especially my home country, Bulgaria, we use euro. So if you got euro, and a lot of banks and a lot of businesses keep a lot of euro deposits and euro in cash, foreign currency sure is good as cash. Even better than cash, okay? Because foreign currency is considered to have lower risk than cash. Now, how is it possible to have lower risk than cash? Well, the answer is very simple. Cash in euro and in US dollars has lower currency risk than cash in Bulgarian leva, Bulgarian currency. So, foreign currency, as long as that foreign currency is considered to have relatively low currency risk, relatively liquid, sure counts as cash. All right? Let's see. Now, what is your question? Well, if you have a question, ask me, not turn back and disrupt your classmate. All right, number 2, short-term investments. This is partly correct. It also would include long-term investments which you intend to sell soon, which you intend to sell within 1 year. And of course, it includes all short-term investments. Short-term investments are investments that will mature within 1 year, or will also include long-term investments that you plan to liquidate within 1 year, to raise cash, to raise liquidity. So these will be the short-term investments. And they can include stocks and bonds and some of these CDs, okay? It may include a non-negotiable CD. You have a CD in the bank, it's 3 months, you can't sell, you can't do anything with it except for hold it, and after 3 months it matures and the bank returns you the money back. It may include other time deposit. A time deposit is a deposit of the bank for a fixed period of time, 30 days, 60 days, 90 days, 180 days, and you can't withdraw it before that. You can't use it, can't sell, can't do anything with it, except for wait for the time and then take the money back from the bank. In other words, get the deposit back. All right? So these are all short-term investments. Those short-term investments need to have 2 characteristics. First one is to have high quality. Yeah, that's a little tricky. I'm reading from the textbook here. You see, current assets, page 31, where it says that these have to be of high quality and low risk. It's not exactly clear in finance. What does it mean, high quality? I don't know. Now, I can tell you what it's supposed to mean. It's supposed to mean low risk. It's supposed to mean like low default risk, low currency risk, low interest rate risk, okay? And it has to mean definitely also positive, high liquidity. All right? High liquidity. Let's see what else. Accounts. Receivable. Accounts receivable will be associated with money which is owed by your own customer. Accounts receivable are created when you sell a product to a customer and the customer has not paid but promises to pay later. Okay? An example will be Hewlett Packard HP selling computers to the university, and when it ships 100 computers, is the university going to pay immediately? Well, the answer is not the same day. They're not going to pay cash for 100 computers. You're going to send 100 computers, they're going to send invoice, and the university will have to pay within 30 days or within 60 days. So account receivable is generated when you have delivered good or delivered service, and here's the key, on credit. So this one is associated with on credit, delivering a good or service on credit. And if it's on credit, the receivable represents the claim against your, and here's the key, customer. So accounts receivable come from, well, let's use the opposite arrow, customers. So, customers, you sold them a good or delivered a service. All right, next one, inventory. An inventory goes in 3 groups. First one is called raw materials. The second one is called work in process. Work in process. And the last one is called finished goods. So, inventory is associated with company's goods for sale. So, the key here is for sale to customers. So, it counts as inventory only if it is for sale to customers. Raw material simply means you bought raw material. It is not ready to be sold to customer, but it will be ready to be processed and made into a finished good, and only then it will be sold. So, only finished goods are for sale. Raw materials will be used in, we call it processing or production. So, raw material, you take it, you process it, we call this processing or production. It's called intermediate good, and when it's finished, becomes finished good. And only the finished good will go to the customer. So, the other two will be used in processing, which we also call manufacturing or production. All right, that's inventory. And yeah, well, that's looks like what they have over here for short term. Well, let's do now long term. I'm moving on page 32. Long term, fixed. There is no one clear standard. You have property. Sometimes within property they put separately land. Others will have, property, there's E letter. Others will have land, okay? Some will have plant. Plant is real estate used for manufacturing purposes, okay? Another one is equipment. And equipment can be moved. Examples of equipment include projector, this particular board, computer, the camera. Corporations use a lot of laptops, they use a lot of mobile phones, so all of these represent equipment. Most often corporations have one separate item, one grouping called property, plant, and equipment, and use all three, property, plant, and equipment, and sometimes they call this PPE, standing for property, plant, and equipment. Sometimes that's the most common group within fixed assets, property, plant, and equipment. In my accounting course, our textbook really insists on having as a separate item within long-term assets called furniture. Furniture is very separate, okay? Furniture includes tables, chairs, and all other things that you can easily throw and replace, but do not have the functionality of equipment. This is common sense stuff. I don't need to explain the difference between furniture like chairs and tables and equipment like computers and projectors and so on. Let's see what else we have. Well, these long-term assets will have depreciation. Let's write it in red. and depreciation simply mean loss of value of an asset because of normal use, because of normal wear and tear. In accounting, they use the word wear and tear. A simple example of depreciation will be that particular Sony camera. Does anybody expect this camera to last 100 years? No, of course not. It's going to get broken maybe within 3, 5, 7 years. Okay, maybe it can make 500 recordings, maybe it can make 1,000 recordings, that's going to be it, okay? So that camera probably going to last 3, 4, 5 years, and just because we use it, open, turn on, turn off, download, hook it up, soon enough, it's going to be fairly used. That's basically wear and tear, okay? It just gets old from usage, all right? That's the wear and tear, that's depreciation. The alternative is called amortization. And amortization is similar to depreciation. It is again falling value, but in depreciation is associated with tangible, assets depreciate, and amortization is within tangible. And the few examples of intangible. And I'm not quite expert into these, will be number one, brand name, brand. A good example of a brand name will be BMW. You guys know BMW? Of course, everybody knows BMW. Everybody wants and likes to have a BMW. Or Mercedes. That's a good brand name. So, there is a special little value on top of the machine because it's a BMW. Another good brand name that everybody recognizes, I'm sure, in this classroom is Sony. That little piece of equipment, that's recording the current lecture, right? Everybody likes Sony. Everybody wants to have a Sony. Most people in the world will recognize a Seiko, okay? Another well-recognized brand name. Probably the most common and widely revered brand name in Asia and even in the US will be Toyota, okay? Everybody likes that Toyota. Solid, reliable, relatively good stuff, right? So that's an intangible. That's the name. Next one will be, and I'm here looking page 32, fixed assets, the third one. Next will be trademark. Trademark is basically a particular name that nobody else can use because that name is associated, like Xerox. Okay, Xerox is a brand name. Okay, it's a trademark name. Trademark means no one else can use the same name. Patent and copyright. Patent means you have ownership. You own this intangible, okay? And copyright. Let's see, copy with Y. Rest with Y. Copyright. Is the right to use a particular patent or somehow a particular intangible. So I have a copyright on the book itself. Now, if you have copyright doesn't mean you have the exclusive. You're not the only one. Maybe 10 different people will have the similar or the same copyright, okay? You don't have to be the one and only who's got a copyright on something, okay? So that's copyright. So all of these represent intangible assets. And these intangible assets have value, and the value is not always retained forever. The value can be usually used up for different reasons, and therefore you need to amortize it. All right? And let's see what else we have. We have current liabilities. Liabilities. And liabilities will be current and long term. Current means that it will have to be satisfied. It will have to be paid for within 1 year. Now, I never said paid for in cash because the liability might not be in the form of cash. The one example that I teach very, very commonly in my first year accounting class is unearned revenue. Unearned revenue is not revenue. Unearned revenue is a liability. They prepaid you cash, and the unearned revenue represents a liability for future product or service. If you paid your university tuition, the university has unearned revenue. Actually, today is November 2nd, and yesterday, November 1st, represents the middle of the semester. But 7.5 weeks, 8's gone, and we've got 8 weeks left. Okay. So if you pay a tuition of 1,000, the university has already earned half of it. So half of your tuition is earned revenue, and the other half of your tuition is still unearned revenue. And the university has no obligation to you to pay you cash or to pay you money. It has the obligation to deliver education service. So, liabilities do not necessarily mean that it has to be made in cash. It may be delivered with a product, okay? It's a promise to deliver computers within 3 months, okay? It's a promise to deliver medicine, okay, within 3 months. So it may be a promise to deliver a good or service in the future, not just cash. Now, what will be including cash? Well, let's see some specific current liabilities. Yeah, short-term loans. Short-term loans. This is simply a short-term loan that you have borrowed money from the bank and you promise to pay back in 3 or 6 months. You go to the bank and say, I need 2-month loan. Bank says, okay, 2 months, no problem. Here's $500,000, 2 months, you gotta pay. Well, that's a short-term loan. Number 2 is trade credit. Well, trade credit is essentially somebody else sold you a product on credit and you promise to pay them next month. Universities use trade credit all the time for practically everything, all right? Universities rarely pay the same day when they get delivered something. All right? It's not that they're bad. It's just, it's a huge university. I mean, not going to be something delivered, you get paid within, 10 seconds. All right? This is not the local supermarket. The university is going to pay. It's got to have documents, procedures, accounting, and other thing. It applies to major businesses too, like IBM and so on. So trade credit is loans that you have received from your business customers or suppliers. You need a particular supply, the supplier gives it to you, you're going to use it for production or something else, and then you will pay them later. Example will be university getting, let's say, gasoline for its cars on credit or some other stuff. All right, trade credit. What else? Oh, dividends. That's weird. All right. Now, let's make it right and correct. Of course, dividend is not a liability. That's absurd. We have a special type. It's called declared dividend. That's what's wrong here in the textbook. So I gotta delete this and write the correct one here. It's called declared dividend. In English, in red. Declared. All right. Businesses are not required to pay a dividend. They don't have to pay a dividend. If they have, they could. Maybe they should. Maybe they have, but they still don't want to. But if the board of directors declares a dividend, if the dividend is decided, declared, voted, declared, and published, the dividend becomes immediately a liability. At that point, it becomes payable. It may happen according to law that if the corporation cannot pay its declared dividend, its investors, the stockholders, can force the company into bankruptcy. They have the legal right to force it into bankruptcy. They have the legal right to demand their dividend if it's declared. The answer is, well, what if they don't have? Well, if they don't have the money to pay, they should not have declared it, okay? If they declared it and 1 month later they don't have the money to pay, then the smart thing for stockholders to do is force the bankruptcy and get them out. Because you don't want to have people, board of director and management, declaring dividend which they can't pay 1 month later, 2 months later. I mean, you don't want that kind of board of directors. You don't want that kind of management. All right? So, declared dividend is strictly a short-term liability as soon as it's been voted and declared. Next, interest payable. You may have borrowed, short-term or long-term. You owe some interest, and you need to pay it. All right? Well, that's interest payable, and it's a short-term obligation. Nothing special. Another one is consumer deposits. A consumer will deposit sometimes money with the business for whatever reason. The business says, okay, we need your money for 1 month, and then we're going to return it or whatever. That's a simple liability. Let's see what else. Within trade credit, I'll just write it here on the side, you have account payable. Look, you'll have to, guys, let's separate. I mean, you just keep, if you have questions, you don't ask him during lecture, okay? So you guys separate again. For now, you don't ask him during the lecture. we record this lecture for you on video so that you can watch it and have all the questions and everything else you have. You can watch it later 10 times. You can forward, back and forth. No, now, why are you distracting him now? All right? I mean, that's why we do this thing. Back to accounts payable. It is part of trade credit or goods and services delivered on credit to you. The other part is called notes payable. The basic difference is that notes payable, actually you have a note. Well, you guys still separate for the rest of the day, okay? I mean, you keep doing this for a while. One of you go far away from the other. A note is a promise to pay, is a written, unconditional promise to pay. A note for 500 or 1,000 simply means it will be paid that amount of money on that particular date, no matter what. Unconditional, full promise. That's it. That's a note. And becomes note payable, okay? Now, if somebody else gives you a note, becomes a note receivable. So, if they make the promise and make the promise to you and give the note to you, it becomes note receivable. If you make a promise and give a promise to somebody else, and the promise is in writing, becomes a note payable. Okay? So, that's it. Let's see what else we have. Well, last one, which they don't have in the textbook, but is clearly a short term, is salaries payable. Salaries payable. You have workers, and workers work for you, and you don't always pay them at the end of the week. Sometimes you pay them at the end of the month, okay? Sometimes you promise them to pay them at the end of the year, okay? And sometimes you promise to pay them at the end of their contract, which is 12 months from, whenever the contract completes. In that particular case, you promise the employee a salary, and for example, for us foreign professors in this university, the university has written and promised us to pay on the 5th of the month. So, I'm working in October, I'm earning salary in October. On the last day of October, the university owes me a salary, and it's called salary payable. It will have to pay on the 5th. That's our agreement. That's what they have been doing every month on the 5th. It's just money that I have to pay a few days or weeks later. That's salaries payable. Another common payable is called taxes payable. Taxes. Let's provide a very simple example. Very simple example is property tax. Government sends you a simple note, and it simply says, it's called a tax note or tax notice. You owe 1 million tax on your property. But the government never says pay tomorrow, they say pay by April. All right? They usually give you 2, 3, or 4 months. So, if they say pay by next April, they just give you 3 months, it becomes taxes payable. Okay? The amount of money you need to pay to the government, but they don't demand immediately, now. I mean, they give you 2 or 3 months. All right, break time, okay? Lecture finished, and we continue with other stuff.